Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, July 24th, and the market is basically juggling three chainsaws: AI earnings, the Fed decision, and geopolitical energy risk.
So a normal Friday, except the chainsaws are branded with semiconductors, interest rates, and oil barrels. I love when my retirement account becomes an escape room with no instructions.
Story 1. Intel's stock jumped after the chipmaker reported blowout earnings and strong guidance, with CNBC saying it rode the AI boom to its fastest revenue growth in almost 15 years. The simple version? Investors are asking whether Intel is finally turning from old-school chip giant into AI infrastructure contender.
Fastest growth in almost 15 years sounds dramatic, like Intel found a gym membership under the couch. But I'm not fully sold, because AI excitement can turn any earnings call into a motivational seminar with spreadsheets.
That skepticism is fair. For normal investors, the lesson is not to chase a stock just because the words AI and turnaround appear in the same sentence. Watch revenue quality, data center demand, capital spending, free cash flow, and guidance.
Story 2 takes us to Hong Kong. SCMP reports Chinese GPU maker MetaX confidentially filed for a listing, with sources saying it was targeting an IPO by the end of this year. Translation: the AI chip fundraising buffet is still open, and apparently everyone brought a prospectus.
Exactly. And GPU demand matters, because these chips are the picks and shovels of artificial intelligence. If AI is the gold rush, GPUs are the hardware store. But IPO investors must still ask whether the store has profits or just a very shiny sign.
I disagree slightly. Sometimes the shiny sign matters because capital markets fund capacity before profits arrive. But yes, if the business model is mostly vibes, a logo, and 3 executives saying ecosystem, I'm keeping my wallet in witness protection.
Story 3. U.S. stocks face tests from the Fed decision and a tech-led earnings deluge, according to Channel News Asia. Think of it like a household budget review. Earnings show income growth, while the Fed decides how expensive the credit card remains.
That analogy hurts because my credit card also holds press conferences. If rates stay higher for longer, mortgages, auto loans, and business financing stay tight, which means even strong tech earnings may not rescue every overpriced stock.
The actionable takeaway: do not treat the market as one giant AI ticker. Split your watch list into quality compounders, cyclical names, defensive cash flow businesses, and speculative trades. Then size positions so one Fed sentence does not ruin your weekend.
Story 4. Beijing pledged to upgrade the China-Europe Railway Express and develop a southern route that bypasses Russia as demand rises for exports like electric vehicles and air conditioners. Basically, China's trying to give its supply chain a backup charger.
And for investors, logistics is not boring. It is margin math on wheels. Faster or more reliable routes can affect exporters, shipping costs, inventory cycles, and inflation pressure, especially when companies are moving bulky goods across continents.
I used to think freight routes were just lines on a map, but they are really the veins of the global economy. Block one artery and suddenly your air conditioner costs more during a heat wave, which is rude and financially humid.
Story 5. CNBC reports a Russian attack cut power to around 150,000 people in Ukraine's north, while Kyiv hit missile and oil facilities. Markets care because attacks on energy infrastructure can feed oil volatility, inflation expectations, and safe haven flows.
This is where personal finance gets very real. Higher energy costs can sneak into groceries, travel, utility bills, and company margins, which is why an emergency fund is not boring. It is your financial umbrella when the macro weather starts throwing furniture.
Exactly. And this is not a call to panic buy oil stocks or dump equities. It is a reminder to stress test your portfolio. Cash needs, debt costs, sector concentration, and whether your AI exposure has become a personality trait.
So today's checklist is: respect Intel's momentum, Question IPO hype. Listen closely to the Fed. Watch logistics routes and keep geopolitical risk in your budget. Also, if your portfolio has more chips than a Super Bowl party, maybe diversify.
That's BD Daily Finance News Podcast for 2026, July 24th. If this helped you turn market noise into a usable plan, subscribe, like, and tell us in the comments, are AI stocks still an opportunity or are they getting crowded?